है प्रार्थना गुरुदेव से ये स्वर्ग संसार हो, अति उच्चतम जीवन बने, परमार्थमय व्यवहार हो। ना हम रहे अपने लिए, हमको सभी से गर्ज है। गुरुदेव ये आशीष दे, जो सोचने का फर्ज है। हम हो पुजारी तत्व के, गुरुदेव के आदेश के, सच प्रेम के नित नेम के, सत्धर्म के सत्कर्म के, ऊंची झूठी राह के, अन्याय की अभिमान की, सेवा करन को दास की, परवाह नहीं हो जान की। छोटे न हो हम बुद्धि से, हो विश्वमय से ईशमय, हो राममय और कृष्णमय, जगदेव में जगदीशमय। हर इंद्रियों पर ताप कर, हम वीर हो अति धीर हो, उज्ज्वल रहे सर से सदा, निज धर्म रत खंबीर हो। अति शुद्ध हो आचार से, तन मन हमारा सर्वदा, आध्यात्म की शक्ति हमें पल भी नहीं कर दे जुदा। इस अमर आत्मा का हमें हर श्वास भरने गम रहे। गर मौत भी आ गई, सुख दुख हमसे सम रहे।
We'll initiate the discussion.
Good afternoon, everyone. Today, me with my co-presenters, Preet and Saksham, will be covering the topic financial instruments. Financial instruments includes three Ind AS, that is Ind AS 32, Ind AS 107, and Ind AS 109. I'll be starting with Ind AS 32, which is titled Financial Instruments Presentation. So, what is the objective of Ind AS 32? That is financial instruments presentation. So Ind AS 32 sets out the principles for classifying financial instruments into financial assets, financial liabilities, and into equity. It also sets out rules for offsetting of financial asset with financial liability, which would be we would be covering later, as well as the presentation of incomes and expenses arising from financial instruments. The scope of Ind AS 32. So Ind AS 32 states that this standard shall apply to all entities and to all types of financial instruments except the following. First, investment in subsidiaries, associates, and joint ventures, since they are governed by Ind AS 110 and Ind AS 27 and Ind AS 28. Employee benefit plans, which is governed by Ind AS 19. Insurance contracts, which is again governed by another Ind AS, that is Ind AS 104. Then share-based payment transactions, which are governed by Ind AS 102. Now there is another item, that is contract for non-financial items. These are not governed by any other Ind AS, but they do not fall under the scope of Ind AS 109. However, such contracts for non-financial items which are intended or which will be settled on a net basis, that is net amount of cash, that is the difference between the contract price and the actual price of that item, will be settled. So if such contracts are to be settled on a net basis, then such contracts would be under the scope of 109. So what are financial instruments? So a financial instruments is defined as any contract that gives rise to financial asset for one entity and financial liability or equity for another entity. So the definition of financial instrument has two components. That is, first, any contract should exist. What is a contract? Contract is an agreement between two parties which is legally enforceable and has some economic substance. Now, the other component is it has a dual impact. That is, it creates a financial asset in the books of the issuer or the receiver and a financial liability or equity for the other party. A question for offline participants. Question is which of the following is or are not of financial instruments? First is trade receivables, second prepaid insurance, third property, plant and equipment, and fourth is investment in debentures. It is correct. Prepaid insurance and PPE are not financial instruments. Why? So first, in prepaid insurance, there is no contractual right to receive either cash or any other financial asset. And for PPE, no contract exists. And for item to be considered as a financial instrument, a contract should exist. Now, defining a financial asset. So for a financial instrument to exist, there should be a financial asset for one entity. So what is a financial asset? Ind AS 32 has defined financial asset as any asset that is either cash. Why cash? Because cash is the medium for exchange. It can be used to obtain future economic benefits in the future. The second one is an equity instrument of another entity. Let's say I bought shares of Reliance Limited, equity shares of Reliance Limited. So for me, that is the holder of the instrument. It will be classified as a financial asset. The third is a contractual right to receive either cash or any other financial asset from any other entity. Fourth, a contractual right to exchange financial instruments with another entity under conditions that are potentially favorable. Now, what does potentially favorable mean? Potentially favorable means that for the issuer of the instrument, or in this case, for the when exchange of financial instruments is happening, it is beneficial for us. Then the last condition, a contract that will be settled or may be settled in entities own equity shares. Now, the contract can be a non-derivative contract. So for non-derivative contract, which may be settled in entities own equity shares, then we are obliged to receive a variable number of entities own equity shares. And for second, that is a contract that may be a derivative. It will be settled uh, other than by exchange of fixed amount of cash or a financial asset or for a fixed amount of entities on equity shares. That is, if either the entities equity shares are in variable or either the cash that we'll receive is variable. So if any of them is variable, then such an instrument will not qualify as a financial asset. Examples of financial asset: first, cash, that is explicitly given in the index. Trade receivables. Why? Because we have a contractual obligation to receive cash from our trade debtors, that's trade receivables. Investment in equity, that is investment in equity shares of another entity, again explicitly given in the index. And fourth, bonds held. Bonds held, so we'll receive either interest or principal repayment. We have an obligation, we have a right to receive interest and principal repayment. So now what is a financial liability? So financial liability is any liability that is first a contractual obligation to deliver cash or any other financial asset to another entity. Second, a contractual obligation to exchange financial instruments, but in a potentially unfavorable condition. That is, the entity would not benefit, the other party will benefit from it. And the third condition is a contract that will be settled in entities own equity shares. Again, if it is a non-derivative contract, a contract for which entity may be obliged to deliver a variable number of shares. And second, if the contract is a derivative, then under such a contract, the derivative will be settled other than by exchange of fixed amount of cash for fixed amount of entities on equity shares. Again, if any of the two considerations is variable, then such an instrument will not classify as a financial liability. Some examples of financial liability: bank loans, since we have an obligation to repay the loan as well as interest component on it. Trade payables, again we have an obligation to pay. Debentures issued, so unsecured debentures or bonds issued by the company represents loan for the company, and again we have an obligation to pay interest or at least the principal amount. Now, redeemable preference shares, and only those redeemable preference shares which are compulsorily redeemable at a specified date. So such preference shares, although we might think that they might be a component of equity, such shares are a financial liability. Why? Because we have a compulsory obligation to pay some amount of money at the time of redemption. So now, equity. So we have understood what is a financial liability, what is a financial asset. if we look at the definitions, the key difference that we'll find is the obligation. In liabilities, there is an obligation to deliver something, whereas in asset, we have the right to receive. So, an equity instrument. So, India's 32 has defined an equity instrument that as an instrument that evidences a residual interest. So, what does residual interest mean? So, since equity shareholders are owners of the company, so a residual interest means that the equity shareholders will receive payment after all the obligations or the liabilities of the entities are settled. So we have a share in the assets of the entity after deducting all of its liabilities. Example, ordinary equity shares. Now, India's 32 has also clarified. India's 32 has also given two conditions. If they are both met together, then such an instrument will be classified as an equity and not a financial liability. So what are those conditions? First, the instrument includes no contractual obligation to either deliver cash or any other financial asset, and no obligation to exchange financial assets or liabilities in a potentially unfavorable condition. And the second condition is that if the instrument will be settled in entities' own equity shares, then if such an instrument is a non-derivative, then there is no obligation to deliver variable number of shares. And if such an instrument is a derivative, then it will only be settled by issuing a fixed number of equity shares for a fixed amount of cash or any other financial asset. So there is an example on the scene. Example one, a company A issues preference shares which are redeemable after 5 years at rupees 1 lakh. So, and the company has no choice but to redeem these shares. So, since they are redeemable, we have an obligation to pay, and such preference shares will be classified as financial liability. Example two, company B issues perpetual preference shares. What does perpetual preference shares mean? They are shares which are not redeemable. So, if a company issues perpetual preference shares and dividends are only payable when declared by the company, that is at the discretion of the company. So, we have no obligation to pay any cash or any financial asset, and therefore they will be classified as equity. Now, the crucial distinction between liability and equity. So, the main point of distinction between liability and equity is that there is either a contractual obligation to pay cash or a financial asset. In this case, the instrument will be classified as a liability. In other cases, it will be classified as equity. So, a question for online participants. So the question is, which of the following scenarios would most likely require an instrument to be classified as a financial liability rather than an equity instrument? Option one, a preference shares that give the issuer absolute discretion to decide whether or not to pay dividends. A perpetual bond where the issuer has no contractual obligation to redeem the principal or pay interest. Third, a bond that is redeemable in cash at a fixed rate. And fourth, a contract that may be settled in the entity's own equity shares by delivering a fixed number of shares for fixed amount of cash.
क्या होता है सेटिंग चेंज नहीं होगी सेटिंग हो ही रहा है
So any of the offline participants, if they can answer the question. The answer is correct. Third option, a bond that is redeemable in cash at a fixed rate. Why are the others not a financial liability? Because we have we have the discretion to pay dividends, or the bond is not redeemable, and neither we have the liability to pay interest. And the fourth option, it satisfies the condition of equity. A fixed for fixed test. So it is a crucial test given by Ind-AS 32, which is used to determine whether an instrument is either an equity or a financial liability if there is an exchange of entities on equity instrument. So when is the fixed for fixed test satisfied? When a fixed number of entities on equity instruments are exchanged for fixed amount of cash or any other financial asset. So we have studied this in the definition of equity. So application of fixed for fixed test, when the test is satisfied, the instrument will be classified as equity, and when the test fails, this will be classified as a financial liability. Now there is a carve out for
कुछ तो ये साइन आ रहा है इसमें जो आप बताओ।
There is a carve out given in Ind AS 32.
ये हर एक के आगे कुछ साइन आ रहा है ना ऐसा। अच्छा ये तो पता ठीक।
There is a carve out in Ind AS 32 for the conversion option in foreign currency convertible bonds. So what is a foreign currency convertible bond? A foreign currency is a bond. A convertible bond is a bond which is issued in foreign currency and which has an option to convert at maturity. So under IFRS, that is IAS 32, International Accounting Standard 32. So a conversion option of a foreign currency convertible bond fails the fixed for fixed test, even though at conversion a fixed amount of cash is payable and a fixed number of equity shares are payable to the holders of the bond. Why does a fixed for fixed test fail? Because the amount will be received in foreign currency, and when such amount will be translated to home currency, that is the functional currency, there will be variance due to exchange rate difference. So IAS 32 classifies it as a financial liability. However, under Ind AS 32, there is an option to classify the option to convert under a foreign currency convertible bond as equity when two conditions are satisfied. First, the bond is denominated in a foreign currency, and second, the conversion option gives a fixed number of equity shares for fixed amount of foreign currency. Now, there is an example on this. An Indian company issues foreign currency convertible bonds with a face value of USD 1 million. So these bonds are issued in foreign currency, carrying interest rate of 5%. Since it is a bond, it will carry an interest rate and maturity of 5 years. So now the bonds are convertible into fixed number of 50,000 equity shares at a fixed rate of USD 21 per dollar. So as per IAS 32, such instruments will be classified as financial liability. Why? Because at the time of conversion, when the amount is translated to functional currency, there will be a variance than the amount that will be decided at the time of recognition. However, under Ind AS 32, the carve-out allows such a conversion option to be classified as equity, even though there is a variable amount that is to be received. Compound financial instruments. So we have understood what are equity and what are liabilities and what conditions must be satisfied for a entity to classify them. But there are some instruments which contain the element of both an equity as well as a liability. Such instruments are known as compound financial instruments. So Ind AS 32 says that such compound financial instruments should recognize the liability component and the equity component separately by a method called split accounting. So what is split accounting? The method used to split the equity component and the liability component in a single instrument. So what are the steps in split account? First, the liability component is calculated. So the fair value of liability component is calculated by the discounted cash flow method. That is the present value of future cash flows using market rate of interest. So the important thing to note here is market rate of interest rather than what the interest rate is provided with the instrument. Second, determining the equity component. So since equity is the residual interest in the company, so the amount of equity component will also be the residual amount. That is the difference between total proceeds that will be received at the time of issuance of such instrument, the fair value that is calculated for the financial liability part. And third, these financial liability component and the equity component are recognized separately in the financial statements. Example on split accounting. Let's say a company issues 1,000 compulsory convertible shares or rupees 1,000 each. So a total proceeds of rupees 10 lakhs have been raised. So the debentures carry 6% interest rate per annum and are redeemable after 3 years when the holders have the option to convert them into a fixed number of equity shares. And the market rate of interest for some such similar non-convertible bonds is 10%. So why is this a compound financial instrument? First, it is a liability because we have a contractual obligation to pay the interest as well as principal amount. And it is an equity because the holders have an option to convert such debentures into equity shares. So now we'll apply split accounting for it. So first, the fair value of liability will be calculated using market rate of interest, that is 10% and not 6% per annum. So after using the discounted cash flow method, the fair value of financial liability works out to be 9,500,000. So now we'll calculate the amount of equity. The equity amount is calculated as the residual amount. That is the difference between total proceeds and the fair value of financial liability. So the total proceeds were 10 lakh and the fair value of financial liability is 9,500,000. So the residual amount, that is rupees 99,500, is allocated to equity. And these financial liability and equity will be shown separately in the balance sheet at the respective amounts. Now, question for offline participants. So, how should an entity initially account for a compound financial instrument such as a convertible bond? Option 1, the entire instrument should be classified as a financial liability until the date of conversion. Option 2, the entire instrument should be classified as an equity since it results in the issuance of shares. Option 3, the liability component is measured first at fair value and the residual amount is allocated to equity component. And option 4, the equity component is measured first at fair value and the liability component is assigned the residual amount. Correct. The third option is correct as per split accounting. Now, offsetting financial assets with financial liabilities. So what does offsetting mean? Offsetting means showing a financial asset and a financial liability at a net amount. Let's say we have a financial asset of rupees 10 lakh and a financial liability of rupees 7 lakh. So in the balance sheet, we'll show them at a net amount that is a financial asset at rupees 3 lakh. So Ind AS 32 has specified two conditions which should be fulfilled in order to offset a financial asset with a financial liability. What is the first condition? Well, the entity has a legally enforceable right to set off such amounts. And second, the entity intends to either settle these on a net basis or to realize the asset and the liability simultaneously. That is, they would be realized at the same time. And if both these conditions are fulfilled, then the entity can offset these financial assets with financial liabilities. Now, treatment of interest, dividend, gains, and losses, that is, income and expenses arising from financial instruments. So, Ind AS 32 specifically states that interest, dividend, losses, and gains relating to a financial instrument shall be recognized as an income or expense in the profit and loss account. But it is also given that distributions to holders of an equity. What are distributions to holders? Let's say dividends. So, dividends shall be recognized by the entity directly in equity, like we always do. And transaction costs on an equity transaction shall be accounted for as a deduction from the equity. That's all for Ind AS 32. Now, I'll also cover a small portion of Ind AS 109, that is the classification of financial assets and financial liabilities. So, what does Ind AS 109 deal with? So, Ind AS 109 deals with the principles for recognition, measurement, and presentation of financial instruments. So, at initial recognition, all financial assets, financial liabilities, and equities, that is, all financial instruments are recognized at fair value. Subsequent measurement depends on how we classify these financial assets and financial liabilities, which is a topic that I'll cover. So, classification of financial assets. Financial assets, as per Ind AS 109, can be classified either at amortized cost or at fair value through OCI, which we call FVOCI from now on, and fair value through PNL, that is FVTPL. So, Ind AS 109 has given two tests to determine whether how a financial asset will be classified. So, the first test is business model test. So, what is the business model test? Business model test is used to determine what is the ultimate objective of the entity. Why has the entity acquired the financial asset? Let's say the entity has acquired the financial asset for trading to recognize the fair value gains or to either to get the contractual cash flows. Let's say a entity has a bond which gives 10% interest. The entity has held the bond for to earn the interest income. And the second test is the CCFT test, that is contractual cash flow test or the SPPI test, which means solely payment of principal and interest test. So the CCFT test is used to determine whether the payments that will be received from the financial asset are solely related to principal and the interest. No other component is involved. So, as per Ind AS 9, there are three business model categories. The first one being hold to collect. So, what is hold to collect business model? The objective is to hold the financial asset and collect all the contractual cash flows. So, hold to collect does not mean the entity won't sell, but all the sales of these kind of financial assets are incidental. That is, the entity does not intend to sell, but it will sell in case holding them will result in a financial loss or any other kind of loss. And second, hold to collect and sell model. That is, the entity has dual objectives. First is to hold the financial instrument to collect the cash flows, and second is to even sell the financial instrument if they realize good gains. And the third one is either the rest all other financial assets, or they can be classified as the business model can be called the trading business model. So in this business model, the entity acquires the asset solely to recognize their fair value change gains through active trading, like selling in the market. So the SPPI test, that is the contractual cash flow test. So we have discussed it is used to examine whether the cash flows represent solely the payments of either the principal or interest. Now the Ind AS 109 has defined principal as the fair value of the asset that we have recorded at the initial recognition. That is, at initial recognition, we always recognize fair value. That is for the principal. And what does interest include? Interest includes components of time value of money, credit risk, or any other kind of risk, administration costs that may be incurred, and a reasonable profit margin. Since we are the issuer of such asset requires profit. Now, what are some cash flows that pass the SPPI test? Fixed or floating rate of instruments which are tied to market benchmarks. Let's say instruments with interest rate that is dependent on LIBOR. Second, instruments with prepayment or extension options. Third is inflation linked bonds. That is the interest rate increases with inflation. And fourth is zero interest loans repayable on demand or at a fixed rate. Now, there are some cash flows which fail the SPPI test. First are instruments with inverse floating interest rate. What are inverse floating interest rate? If the interest rate in the market increases, the interest rate payable on such an instrument will decrease. That is, there is an inverse relationship in the market rate of interest and the interest payable on such instruments. Second, perpetual instruments where deferred interest does not accrue. Third, instruments with leverage, example forwards or swaps. And fourth is return linked to debtors performance or equity or commodity index. Let's say there is an entity X has issued an instrument which is the interest rate on such an instrument is dependent on the net profits of the entity. So it will not pass the contractual cash flow test. Now, question for online participants. Which of the which of the following features in a financial instrument would most likely cause it to fail the SPPI test? Option 1, a provision that allows interest rate to be adjusted periodically based on changes in market rate of interest, example LIBOR. Option 2, instrument with inverse floating interest rates. Option 3, a prepayment option that allows the borrower to settle the loan early by paying outstanding principal amount and the accrued interest. And option 4, a time value of money element that has been modified, but it still provides a return that is consistent with basic lending agreements.
Ashita Khandelwal.
Answer is option 2.
अक्षता आवाज नहीं आ रही आपकी, एक बार भास्कर.
Answer is option 2.
Answer is correct. Instruments with inverse floating interest rates. Now, how will the financial assets will be recognized at amortized cost? So, the Ind AS 109 states that two criteria must be fulfilled in order to classify an asset at amortized cost. First, the business model must be hold to collect. That is, the objective is to collect all the contractual cash flows. And second, the SP or refundable security deposits. Now, category 2, that is fair value financial assets recognized at fair value through OCI. So, financial asset to be classified at FVOCI should fulfill two criteria. First, the hold to collect and sell business model should be fulfilled, and second, the SPPI test should be passed. So, for debt instruments classified at FVOCI, the accounting shall be the interest income from such instruments and should be recognized in P&L. However, the fair value changes should be recognized in OCI. And upon derecognition of such financial assets, the OCI amount shall be reclassifiable to P&L. And the second, equity instruments at FVOCI. So, as per Ind AS 9, the general provision is equity instruments should be classified at FVTPL. However, if equity instruments are not held for trading, that is, they are held to hold. So, such equity instruments have an irrevocable option to recognize them at FVOCI. So, accounting for the same would be all the fair value changes would be recognized in OCI, but the dividend payable on these will be recognized on dividends receivable will be recognized in P&L. And upon derecognition of such assets, the balance in OCI is not transferable to P&L. So the key difference between debt and equity instruments classified as FVOCI is that the balance in OCI is not transferable to P&L at the time of derecognition. A category 3, that is financial assets at fair value through P&L. So it is the residual category, that is the assets which are not classifiable under FVOCI or at amortized cost shall be classified at FVTPL. However, Ind AS 109 has given a provision to classify all financial assets at FVTPL in case they significantly reduce or eliminate an accounting mismatch, even if they would be classifiable as at amortized cost or at FVOCI. So some examples of financial assets classified through P&L are assets held for trading since they don't pass the SPPI test. Equity instruments, since there is the default for equity instruments is FVTPL, and any other debt instrument that does not pass the requirements for amortized cost or FVOCI. So here is a flow chart for determining whether the asset should be classified as a at FGOCI, at amortized cost, or FBT. So for debt instruments, if the contractual cash flow test passes, so they will be if the what is the business model. If the business model is hold to collect, then they will be classified at amortized cost. If the business model is to collect the contractual cash flows, X plus sell them, it will be classified at FBOCI. If both business model test fails, then they will be classified at FBTPL. Now for derivatives are always classified as FVTPL. That is the change in the value of derivatives will always be recognized in P&L. And for equity, if such equity is held for trading, uh, then it can be classified at FVOC. That is the irrevocable option that we discussed earlier. And if the irrevocable option is not selected, then they will be classified at FVTPL. Now, question for online participants. An entity makes an irrevocable election to present fair value changes of a non-trading equity investment in OCI. Where are the dividends from such investments recognized? Option 1, profit and loss. Option 2, retained earnings. Option 3, OCI. Or option 4, reduce the carrying amount of such investment.
Team Hayat.
टीम हयात पे कौन कौन है?
Jula Jain.
Option A, profit and loss.
Jula voice not audible.
The answer is option A, profit and loss.
The answer is correct. Dividends will be recognized in P&L. So how would financial liabilities be classified? So the classification for financial liabilities is simple. Most of the financial liabilities are recognized at amortized cost. However, those financial liabilities which are held for trading should be classified at FVT. There is another kind of financial liability that is a contingent consideration that is recognized by the acquirer in a business combination. Such contingent consideration payable should also be recognized in at FVTPL. There is also a provision for recognizing any financial liability at FVTPL if it eliminates or significantly reduces an accounting mismatch, the same as for a financial asset. So there is an illustration on accounting mismatch. So an entity purchases a fixed rate asset. Let's say it purchased a bond carrying a 6% interest rate by a fixed rate debentures. So there is an asset which gives us interest and a debenture on which interest is repayable. So classifying both at FVTPL will reduce the mismatch. That is, the interest payable and interest receivable will set each other off. However, if one is measured that, let's say the financial asset is measured at FVOCI, so the gains will go to OCI while the liabilities are measured at amortized cost. So under amortized cost, when unwinding takes place, the financial cost goes to P&L. So there would be an accounting mismatch. So to reduce such mismatch, we can classify them both as at FVTPL. So the key takeaways for Ind AS 109, the classification. So the initial recognition takes place at the fair value of the asset, liability, or equity. The subsequent classification depends on the subsequent measurement depends on the classification of such assets or liabilities, which are dependent on tests like business model test or the SPPI test. Thank you. That's all from my side.
जॉन कुछ एक्सप्लेन करना है? अर्सरी अच्छा एक्सप्लेन किया इसने, खुद ही पॉइंट एक्सप्लेन किया एंड एडमायरेबल था। इनफैक्ट जब हम लोगों ने फाइनेंशियल इंस्ट्रूमेंट पढ़ना शुरू किया ना आज से 10-12 साल पहले, तो समझ ही नहीं आता था कि ये क्या है। एंड आई थिंक इसने फर्स्ट अटेम्प्ट में बहुत अच्छे से टू द पॉइंट एक्सप्लेन किया है और ऑलमोस्ट जो भी एक फाइनेंशियल इंस्ट्रूमेंट से डेफिनेशन से रिलेटेड जो चीजें हैं वो कवर की है। तो अगर अपन बैलेंस शीट को देखते हैं ना, तो बैलेंस शीट में कौन कौन से आइटम इस स्टैंडर्ड से कवर होते हैं? इट इज वेरी इंपॉर्टेंट स्टैंडर्ड फ्रॉम द ओवरऑल बैलेंस शीट रिव्यू पर्सपेक्टिव ऑल्सो। तो कौन कौन से, जस्ट इमेजिनेशन के बेसिस पे आप क्या क्या आइटम है जो फाइनेंशियल इंस्ट्रूमेंट है? एक एक करके बताइए। हाँ, रिसीवेबल्स, पेबल्स फाइनेंशियल इंस्ट्रूमेंट्स हैं और पहले क्या बोलूं, इन्वेस्टमेंट्स जो आप कह रहे हो दो फाइनेंशियल इंस्ट्रूमेंट्स हैं, और जितने भी लोन्स आपने ले रखे हैं दे आर फाइनेंशियल इंस्ट्रूमेंट्स। डिवेंचर्स आपने ले रखे हैं या डिवेंचर्स में इन्वेस्टमेंट किया हुआ है, कैश एंड कैश इक्विवेलेंट आर फाइनेंशियल इंस्ट्रूमेंट्स। सो सिक्योरिटी डिपॉजिट्स आपने ले रखी है, दे आर फाइनेंशियल इंस्ट्रूमेंट्स। प्रेफरेंस शेयर्स आपने ले रखे तो वो देन वी नीड टू क्लासिफाई की वेदर इट इज इक्विटी और फाइनेंशियल। बट अगर आपने प्रेफरेंस शेयर में पैसा लगा रखा है तो इट इज योर फाइनेंशियल इंस्ट्रूमेंट्स। तो ये एक स्टैंडर्ड है जो ऑलमोस्ट बैलेंस शीट के 40-45-50% आइटम्स को कवर करता है या नहीं है? These three standards cover, किसी भी बैलेंस शीट में आप अगर परसेंटेज वाइज निकालोगे ना टोटल उसकी कितनी एसेट्स है और कितनी लायबिलिटीज है, तो आप देखोगे कि मोस्ट ऑफ द आइटम्स आर कवर्ड बाय these three standards। इन नर्सरी एक ही स्टैंडर्ड है क्योंकि इसके अंदर प्रेजेंटेशन, रिकॉग्निशन, मेजरमेंट और डिस्क्लोजर्स, ये तीनों के अलग अलग स्टैंडर्ड्स इन्होंने दिए हुए, but actually it is one standard related to one item that is called financial instruments। जिसमें assets भी हैं और liabilities भी हैं। Then जो इसने 109 कवर किया है, 109 में इसने क्लासिफिकेशन को कवर किया है। तो क्लासिफिकेशन, see what are the intentions behind these classification, ये हमें थोड़ा और एक्सप्लेन करना चाहिए और समझना चाहिए। तो इन्होंने बोला कि साहब अगर किसी का इंटेंशन है होल्ड करने का, अगर किसी का इंटेंशन है होल्ड और सेल करने का, या किसी का इंटेंशन है ट्रेडिंग करने का, यही तो है ना? तो बेस्ड ऑन द इंटेंशंस वी नीड टू क्लासिफाई डिफरेंट फाइनेंशियल इंस्ट्रूमेंट इनटू डिफरेंट कैटेगरीज। होल्ड का मतलब क्या है? अगर वो इन्वेस्टमेंट्स है तो होल्ड मतलब टिल मैच्योरिटी हमें इसको रखना है। हमारा जब हमने इसमें इन्वेस्टमेंट किया तो हमारा इंटेंशन था कि हम इसको टिल मैच्योरिटी रखेंगे। तो दैट वाज कॉल्ड एज बिजनेस मॉडल टेस्ट। बिजनेस मॉडल टेस्ट है। और जो दूसरा टेस्ट है वो क्या है? कॉन्ट्रेक्चुअल कैश फ्लो टेस्ट, कैरेक्टर टेस्ट। तो बेसिकली पैसा कैसे आ रहा है, वेदर इट इज फिक्स्ड या इट इज नॉट फिक्स्ड। आप जब रीडिंग करोगे उसको क्या वैल्यू होगा, उस वैल्यू के बेसिस पे पैसा आएगा। तो कैश फ्लो टेस्ट भी हो गया और बिजनेस मॉडल भी टेस्ट हो गया। कैश फ्लो टेस्ट में अगर उसका फिक्स्ड एंड डिटरमिनेबल यूनिट ऑफ पैसा आपके पास में, मनी आपके पास में वापस आ रहा है और अगर आप उसको होल्ड टिल मैच्योरिटी कर रहे हो तो इन दैट केस इट विल बी क्लासिफाइड
दोनों
एज
बैठ बैठ के निकाले जा रहे थे
amortized cost. लेकिन अगर फिक्स्ड एंड डिटरमिनेबल अमाउंट ऑफ करेंसी नहीं है तो ऐसे केस में क्या होगा? फेयर वैल्यू थ्रू प्रॉफिट एंड लॉस, और यू हैव ऑप्शन टू कैटेगराइज द सेम एज फेयर वैल्यू थ्रू अदर कॉम्प्रिहेंसिव इनकम. तो बहुत सिंपल है ये सारी चीजें, ऐसा कुछ नहीं है कि, बट देन यू नीड टू ऑलवेज सी दैट व्हाट आर द लॉजिक्स, हाउ डू वी कैन एक्चुअली डिसाइड इन बिटवीन. तो ये पढ़ने में कॉम्प्लेक्स लगता है, जब आप डिस्कस करते हो तो आई थिंक यू कैन अंडरस्टैंड दी बेटर. अगर आप इस स्टैंडर्ड को आइसोलेशन में पढ़ने लगोगे ना तो आपको समझ ही नहीं आएगा, और इन्होंने एक्सप्लेन कर दिया और अब जाकर के आप पढ़ोगे तो देन यू विल बी एबल टू अंडरस्टैंड इट बेटर. कितने मार्क्स का आया था फाइनेंशियल स्टूडेंट्स? है काफी था. वेटेज आता है फाइनेंशियल इंस्ट्रूमेंट्स का फाइनल के एग्जाम में.
So now we will covering the measurement and derecognition part of the financial instrument. First, we will cover the initial measurement of financial instrument. Any financial instrument, either financial asset or liability, is measured on initial recognition at fair value. What is the fair value? On initial recognition, fair value of any financial instrument is the transaction price plus minus any adjustment related to transaction cost. For example, if a entity takes a loan of rupees 10 lakh rupees and transaction cost is incurred 50,000 rupees, then the fair value at initial recognition shall be 10 lakh minus 50,000, that is 9 lakh 50,000 rupees. But there is one exception in this that in one case transaction cost is not adjusted to the transaction price of the financial instrument, but it is classified to P&L. Can anyone guess what is that case? Yes, FVTPL. If the financial instrument is measured at FVTPL, then the transaction cost on initial recognition is transferred to P&L and not to be adjusted to the transaction cost, not to be adjusted to transaction price. Now we will discussing certain cases in which the fair value of initial recognition is not equal to the transaction price. First is when there is a pre-existing relationship between the borrower and lender. Second, when there is a compound financial instrument, but this is only possible in case of financial liability. And third, when the fair value is based on the level one input. In all these three cases, fair value of financial liability or financial asset is equal to the present value of future cash flow discounted at market rate. Now discuss the treatment of difference arising from transaction price and fair value in all these three cases. In case of level one input, fair value of financial liability is equal to the present value of discounted cash flows. Any difference between fair value and transaction price is recognized immediately through P&L. In case of compound financial instrument, so compound financial instrument cover both equity as well as liability component. So fair value of financial liability is same present value of discounted cash flows at market rate. Any difference between the fair value of liability and the transaction price is transferred to equity component, that is other equity. We will discuss the different cases of CFI in next slides. Third is when there is a pre-existing relationship with the borrower and lender. In this case, financial asset or financial liability are measured at fair value, and any difference between transaction price and fair value is treated according to the nature of relationship between borrower and lender. Now there is a question for online participants. A financial asset is initially recognized at fair value. In case the asset is classified as FVOCI, transaction costs are expensed immediately in P&L, added to the fair value of asset, ignored completely, or recognized in OCI.
Radhika and Dimple.
Answer is option B, added to the fair value of asset.
Yes, the answer is correct. B, added to the fair value of asset. Now we will discussing different type of treatment in different type of nature of relationships. First one, when there is a employer-employee relationship between the borrower and lender. Suppose employer gives loan to its employee at a rate of interest that is below the market rate of interest. Then the then the fair value of financial liability is the present value of all the cash flows discounted market rate of return. Then the difference between financial liability, then the difference in the financial asset and the transaction price is treated as prepaid employee benefit expense by the employer. And as the employee does not apply Ind AS, so he will treat it as normal loan. Second, when there is a lessor and lessee relationship between the lender and borrower. Suppose lessee gives a not refundable deposit, but with a zero interest rate to the lessor. Lessor will recognize it as financial liability at fair value, and any difference between both will be classified as advance rent received by the lessor. And in the books of lessee, any such difference is considered as right of use asset as per Ind AS 116. Third case is when parent gives loan to a subsidiary. When parent gives loan to subsidiary at interest rate that is lower than the market rate of return, market rate of interest, then the difference arising on day one shall be treated as investment in subsidiary by the parent and capital contribution by the subsidiary. Fourth one is when subsidiary gives loan to its parent. When subsidiary lend to parent at less than market rate of return, then the day one difference arising is recognized as dividend income by the parent and the dividend distribution by the subsidiary. Fifth case, when there is a government grant. If government grant a loan to any company at below market rate, then the company will record the financial liability at fair value, and any difference between the fair value and transaction price is regarded as government grant by the borrower as per Ind AS 20. Now we're taking a practical example in case of security deposit. Suppose customer make 10,000 interest-free deposit refundable after 3 years. Market rate of interest is 7% per annum. Then the fair value on initial recognition is the 10,000. We will discount the 10,000 at 7% for 3 years. That the fair value arises 8163, and the day one difference of 1837 is recognized as ROE asset in the books of customers. The differential represent lost interest and qualifies prepaid asset by the this ROE asset is amortized over the period of lease term. Now we'll discussing different cases of compound financial instrument. Yeah. A compound financial instrument covers both equity and the liability component. On initial recognition, financial liability is measured at fair value. The fair value of financial liability is the fair value of financial liability is the present value of future cash flow discounted market rate of return. And the equity component is the residual part, that is the transaction price minus the fair value of financial liability. Now, the first case of CFI is when CFI is without transaction cost. In this case, normally fair value of financial liability is the present value of future cash flow discounted at market rate. And the difference between fair value and transaction price is transferred to equity component. For example, XY Limited issued 10% debenture. It has face value of 25 lakh, redeemable or convertible after 5 years. Market rate of return without conversion option is 14%. So here the market rate of interest is more, but we issued debenture at 10% because it has convertible option also. In this case, we'll calculate the fair value financial liability, that is 21,56,700, and the residual part of 3,46,300 is considered as equity component transferred to other equity. Second case, when there is a CFI but with transaction cost. In this, we have to first calculate the fair value of financial liability and equity, assuming there is no transaction cost. Then we will allocate the transaction cost between financial liability and equity in the ratio of fair value. And the third one, the assigned portion of transaction cost to equity is transferred to other equity, and the assigned portion of transaction cost to financial liability is deducted from the financial liability on day one. In this, there is one example. Suppose company issued 8% convertible debentures. That is fair value of 80,000 rupees and 3 years, and a holder has option to convert it into equity shares. Without convert option, market rate of return is 12% and the transaction cost incurred is 2,000 rupees. In this, first we have calculated the fair value of financial liability and equity with no transaction cost. So fair value of financial liability is the interest income, that is 80,000 or with 8% interest coupon rate. So 6,400 5 years के 3 years का इंटरेस्ट आएगा उसको एंड 80,000 जो रिडम्पशन अमाउंट भी होगा एट द एंड ऑफ थर्ड ईयर उनको डिस्काउंट करेंगे एट 12%. सो फेयर वैल्यू आएगी फाइनेंशियल लायबिलिटी की 17,314 एंड द फेयर वैल्यू ऑफ इक्विटी which is the residual amount is 7,686. Now we will allocate the transaction cost of 2,000 rupees between financial liability and equity in the ratio of fair value. So the amount of transaction allocated to financial liability is 1,808 and the allocated to equity is 192. Then we will calculate the revised fair value of financial liability and equity as financial liability initial fair value minus transaction cost allocated. So it comes to 70,506 and the equity part 7686 minus 192, it comes at 7494. So we'll record the cash bank received 70,000 and record the financial liability at 72,506 and equity at 7494. Now we'll see the third case in CFI, that is early settlement of compound financial instrument. In this case, firstly we will allocate the settlement price to the remaining liability and equity component. How will allocate this price? So value allocated to the FL will be based on the fair value of remaining liability at that point of time using the new discounted, and the remaining settlement amount is allocated to equity component. So then we will recognize the gain and loss related to the liability component in the P&L, and the gain and loss related to the equity component is recognized in other equity. Now we will take an example on early settlement of compound financial instrument. Suppose on 1 April 2019, Shelter Limited issues 5,000 8% debenture maturing on 31st March 2024. The debenture converted an option of holder into equity share at a conversion price of 105 per share and the redeemable at the face value of 100 each. Interest is payable annually in cash. At the date of issue, Shelter Limited could have issued non-convertible debt with a 5-year term bearing a coupon interest rate of 12%. So the market rate of return is 12%. On 1st April 2022,
इतना
क्या बात है?
screen share बंद
इनसे चालू होता है?
No.
फ्री?
No.
फ्री
So at the date of issue, Shelter Limited could have issued non-convertible debt with a 5-year term bearing a coupon interest of 12%. So the market rate of return is 12%. On 1st April 2022, convertible debentures have a fair value of 5,25,000 and the Shelter Limited makes a tender offer to debenture holder to repurchase the debenture for 5,25,000, with the holder accepted. At the date of repurchase, Shelter Limited could have issued convertible debt with a 2-year term, that is the remaining term of the previous instrument, at a coupon interest rate of 9%. Means the market rate of return at that time after 3 years is 9% per annum. Then first we'll calculate the fair value of financial liability and equity. Fair value financial liability at the initial will be the discounted amount of cash flows at 12% per annum, which comes at 4,27,904. And the fair value equity, which is the residual part, is 72,096. So the amortized cost at the end of third year is 4,66,197. Then at the end of third year, we will calculate the fair value of financial liability remaining at the end of third year. So 2-year cash flows and the redemption amount is discounted at for 2 years. So fair value of financial liability is 4,91,204. So we will allocate the settlement price of 5,25,000. So 4,92,204 allocated to the financial liability, and the remaining part of 33,796 allocated to the equity. Then the loss on the settlement of FL is carrying amount minus the fair value, that is the purchase price allocated to the financial liability, that is 25,007, that is transferred to the P&L, and the gain on the sale of equity part, that is carrying amount minus fair value allocated, that is 38,300 is transferred to other equity. Now we will covering the subsequent measurement of financial asset and liabilities. All financial assets are categorized on subsequent measurement in 3 categories. First is amortized cost, second EBITDA/OCI, and third is EBITDA/PL. In amortized cost, any financial asset is classified at amortized cost by adding the interest with EIR, that is calculated effective interest rate, and after reducing the repayment. So the closing balance is known as amortized cost, and fair value is measured at amortized cost. Second is when in EBITDA/OCI, all the financial assets are measured at fair value, and any changes in fair value is transferred to OCI. Third is EBITDA/PL. In this case, also financial asset is measured at fair value, and any changes in fair value is transferred to P&L directly. Now, EBITDA/OCI, there are 2 cases. If debt instruments are classified at EBITDA/OCI, then the interest and impairment and expense are transferred to P&L, and any fair value changes are transferred to OCI. That is also reclassified on disposal when the financial assets are transferred. In equity EBITDA/OCI, it is an irrevocable option, as all equity shares are measured at EBITDA/PL. But there is irrevocable option to measure equity shares at EBITDA/OCI. But it on settlement, it will not be reclassified to P&L, and any dividend received on those equity shares are directly transferred to P&L. Second is financial liability. All the financial liability on subsequent measurement are mostly defaultly measured at amortized cost. For example, trade payables, bank loan, debentures, all those financial liability are measured at amortized cost only. And the EIR method is applied for interest expense that is being paid, and the interest and dividend paid किया जाता है वो P&L में classify कर दिया जाता है. Now second is when some financial liability are held for trading or they are held for derivatives, then we have an option to classify it as EBITDA/PL. In this, the instrument is measured at fair value, and any changes is transferred to P&L, and interest and dividend paid is also transferred to P&L. Now we have summary for subsequent measurement of financial asset. On initial measurement, in all method, financial asset is measured at fair value plus transaction cost. But in case of EBITDA/PL, it is measured only at fair value. Second, transaction cost in all the methods, either ACM, either amortized cost, EBITDA/OCI, or EBITDA/OCI NR, transaction cost is added to the fair value on initial recognition. But in case of EBITDA/PL, it is transferred to P&L. Now, subsequent measurement at each balance sheet date. In amortized cost method, subsequently asset is measured at amortized cost. In EBIT OCI R, asset is measured at fair value, and same in EBIT OCI NR and PL, asset is measured at fair value. Any interest and dividend in any of the case is directly transferred to P&L. Any unrealized gain loss that is not applicable in the case of amortized cost because asset is measured directly at amortized cost. So fair value through OCI and fair value through P&L. इन केसेस में अनरियलाइज गेन लॉस हो सकता है, तो इस केस में all the unrealized gain loss in case of EBIT OCI R is classified to OCI, and in case of EBIT OCI NR it is also classified to OCI, but it is not reclassified at the when the asset is being transferred. And in the case of EBIT PL, any unrealized gain loss is also transferred to P&L. Treatment of previous unrealized gain loss on sale. Any previous unrealized gain and loss in case of asset is measured at EBIT OCI R, it is reclassified to P&L. Also, transfer between other equity shall take place. In case of EBIT OCI NR, all the amount that is being transferred to OCI is now being reclassified to P&L, and also the transfer between other equity will take place. Now we'll see the summary of subsequent measurement in case of financial liability. For financial liability, ACM is a default criteria, but for some financial liability which are held for trading, an entity elect to measure it at EBIT-PL, it has measured at EBIT-PL. On initial recognition, fair value. On initial recognition, the amount is measured at fair value minus transaction cost, and in EBIT-PL, it is measured at fair value. For transaction cost, in case of ACM, it is deducted from the fair value, and in case of EBIT-PL, it is transferred directly to P&L account. Subsequent measurement amortized cost के केस में अप्लाई नहीं होता क्योंकि asset financial liability डायरेक्ट amortized cost पे मेजर की जाती है. But in case of EBIT-PL, it is measured at fair value, and any unrealized gain loss is transferred to P&L, and any interest and dividend paid in both the cases are transferred to P&L. Now there is one question for offline participant. A company holds debt instrument to collect contractual cash flow. The cash flow represents solely payment of principal and interest. The asset shall be measured at. Yes, the answer is correct. The asset is measured at amortized cost. Now we will discussing reclassification of financial asset and liabilities. So reclassification will only take place if there is a change in the business model of the entity, or reclassification shall apply prospectively from the beginning of the reporting period. It is not reasonable to change the business model or reclassify the financial liability at the mid of the year, but it is only can be reclassified at the beginning of the reporting period. But in case of equity shares that is measured at EBIT OCI, not reclassified, then it is a irrevocable option so it can not be reclassified to any other method. Then there is one question for online participant. Financial liability are subsequently measured at always at amortized cost, always at EBIT-PL, amortized cost except those designated at EBIT-PL, and last is EBIT OCI.
Dimple Halchandani. Dimple. Prince Sharda.
But the answer is option C, amortized cost except those designated at FVTPL.
Repeat again, Prince.
So the answer is option C, amortized cost except those designated at FVTPL.
Yes, the answer is correct. Amortized cost except those designated as EBITPL. Now we will discussing about the derecognition of financial asset. So here, what is derecognition? Derecognition determine when to remove a financial asset from the balance sheet. Suppose we have a trade receivable in our balance sheet, and we give our trade receivable to any factor for collecting payment. So either it will be derecognized from the balance sheet or not. It depends on the two conditions. First is when contractual right expire, and third is when asset is being transferred. So first, when the contractual right relating to that financial asset to receive cash flows are expired naturally, and the second one is when asset is being transferred. Uh, for this, we will evaluate the extent of risk and reward that is being retained by the entity. In derecognition, we have three scenarios. In first scenario, entity substantially transfer all the risk and reward relating to the financial asset. In this, first is full derecognition. When the full financial asset and the risk and reward related to that asset is being transferred, we will derecognize the entire asset, and any difference is transferred to the P&L. Second is partial derecognition. In this case, not the complete financial asset, but a specific part or specific identified cash flow is being transferred. But the risk and reward related to that part is being substantially transferred by entity, and entity does not retain any risk and reward relating to that part, which is being transferred. That is partial derecognition. So we will discussing partial derecognition in detail. Partial derecognition apply when only a part of the financial asset is transferred, neither full financial asset is transferred. In this, we have two cases. First, that meet the qualifying condition, which is discussed in next slide, and the case B, which does not meet those qualified conditions. So we discussed the qualifying conditions. In, First is when entity transfer identified cash flow. When the part transfer comprises of a specifically identified cash flow, suppose entity issues the debentures, and it has two component to receive, a interest component and a principal component. The entity either transfer principal right to receive principal component or a right to receive interest component. Then it is covered in this condition. Second is pro rata share. When the part transfer comprises of fully proportionate share of the all the cash flows from a financial asset. Suppose entity issued debentures and it has two component, principal and interest. Entity transferred a proportion of both the cash flows. Suppose 40% of interest and principal. Third is pro rata of identified cash flows. In this, part transfer comprises of fully proportionate share of a specifically identified cash flow. Suppose the entity shares 50% of interest or 40% of principal component. So if those qualifying conditions are met, we have the three-step accounting. First, we will calculate the fair value of the part derecognized and the part retained. Second, we will split the carrying amount between of part derecognized and the retained between based on the fair value calculated in the step number 1. And third, we will remove the derecognized part at the carrying amount and recognize the retained part. We will derecognize the derecognized part at a fair settlement amount, and in difference transfer to P&L, and the remaining part that is part retained is being carried at carrying amount. For this, we have an example. C Limited has lent a sum of rupees 10 lakh at 18% for 10 years. Loan had a fair value of 12,23,960 at a EIR of 13%. To mitigate prepayment risk, but at the same time retaining control of the loan, C Limited transferred its right to receive the principal amount of loan on its maturity with interest after retaining right of 10% principal, 4% interest that carries fair value of 29,000 and 1,84,620. So here the part retained is the 10% principal and the 4% interest. The consideration for the collection was 9,90,000 rupees, So the settlement price is 9,90,000 rupees. The interest component retained, that is 4% interest, is also included 2% fees toward the collection of principal interest that has a fair value of 65,160. You are required to follow journal entries. So in this first we calculate the fair value of part recognized and the part retained. Fair value of part retained is 10% principal that is being given 29,000 rupees. 4% interest fee fair value given, that is 1,84,620, but it includes the 2% service fee. So we will deduct it, and the fair value of 4% interest comes at 1,19,460, and the 2% service fees, that is 65,160. The total fair value of part retained is 2,13,620. Total fair value is at 12,20,960. So the fair value of part B recognized is 10,10,340. Now we will allocate the carrying out of this 10 lakh rupees in the value in the ratio of fair value. So the carrying amount of part D recognized is 8,21,000, and the carrying amount of part retained is 1,74,532. So we will record the retained portion at carrying amount. So the carrying amount is distributed in the various value fair value. So the fair value retained portion of the fixed asset is measured at carrying amount, that is 1,70,532, and any gain loss relating to that part D recognized is transferred to P&L. In case B, when the condition is specified above are not met, suppose we have sold first 80% of cash flow or first 2 years of interest. In this, we will de-recognize the entire financial asset, and the retained portion is recognized at fair value. Service fees treatment. Service fees can apply in both the cases, as we see in the above example. 2% service fees is being included in the 4% interest part. So service fees can be recognized at carrying amount in case of case A, and if it does not meet, it is being recognized at fair value. Now there is one question for offline participant. A company transfer receivable to a bank but retains substantially all risk and reward of ownership. The receivable should be de-recognized completely, partially de-recognized, continue to be recognized, and be recognized in OCI. Yes, it will be continue to be recognized. Then now we will take scenario B, substantially retain all risk and reward. If entity transfer its right to receive a cash flow from financial asset, but it does not transfer risk relating to an asset. Suppose entity has a trade receivable of 10 crore rupees. It transfer it right to receive to a factor at 9 crore rupees. So entity receive 9 crore at today, and the factor will receive the amount of trade receivable on due date. In this case, if it will entity retain all the risk, if debtor does not pay, entity will pay to the factor. So in this case, entity does not transfer it risk relating to that asset. So entity does not de-recognize that financial asset or debtors from its books, and will either record a financial liability for the amount received, that is rupees 9 crore. Now the third scenario is when entity neither transfer nor retain the complete risk and reward. In this, we have to identify what are the amount of portion that is on which control is not retained, or the portion on which control is being retained. For control portion, that is if entity transfer 5 lakh rupees debtor to a factor, at 4,50,000 rupees, but entity retain the right risk of 20,000 rupees. That if debtor fails to up to the extent of 20,000 rupees, entity will pay to it. So entity will transfer right, will retain control over the 20,000 rupees debtor. So in this case, we will apply continuing involvement accounting and will record the portion of retained control as a continuing involvement asset account, and will book an associate liability relating to that asset. Now we will taking de-recognition of financial liability. In financial liability, there is no condition when the contractual right to pay is discharged, cancelled or expired, and financial liability is been derecognized. Thank you. This is all from my side.
Thank you, Preet. Now I am Sakshanjan will cover the remaining topics of Ind AS 109. So let us continue with the modification of financial instruments. Modification of financial instruments means a change in the original contractual terms which was entered when it is initially recognized. It can take place due to various reasons. Some of the reasons are change in implement schedule, extension of tenure, and change in interest rate. So, what is modification of financial liability? It is also termed as extinguishment accounting. Modification of financial liabilities represent a significant change in contractual terms between lender and borrower. Modification of financial liability can be of two types: substantial modification or non-substantial modification. So, how we can determine whether this modification is substantial or not? We perform the 10% test, in which we firstly calculate the difference between present value of modified cash flows at the rate old DIR and carrying amount of old financial liability. Then the result will be divided by carrying amount of financial liability. If the difference is more than 10%, it is substantial. But if the difference is less than 10% or 10%, it is a non-substantial modification. So now let us see the accounting treatment in case of substantial modification of financial liability. Firstly, we will derecognize the old financial liability at carrying amount, and then we will recognize the new financial liability at fair value. The difference arising of them will be transferred to profit and loss account, and the transaction cost, if any, will be transferred to P&L account. Now let us have a practical illustration which explains the substantial modification accounting treatment. Let's say we have a original loan amount of rupees 10 lakh, interest rate is 10% per annum, carrying amount of old loan is 8,50,000, and present value of modified cash flow at original EIR is rupees 740,000. The percentage change is clearly more than 10%, that is 12.94%. So yes, we will follow the substantial modification accounting treatment, in which we will recognize the old financial liability at carrying amount, that is modification liability debit rupees 50,000 to modification liability new liability rupees 740,000, and the difference arising rupees 110,000 is transferred to P&L.
ये कहाँ होता है इस तरीके का मॉडिफिकेशन जनरली? तो एग्जांपल्स हैं कि यहाँ पे मॉडिफिकेशन होना चाहिए या
लोन रिस्ट्रक्चरिंग,
जैसे लोन्स की रिस्ट्रक्चरिंग होती है ना, बैंक्स के आपके डिफॉल्ट हैं, तो बैंक्स के पास आप गए और आपने कहा कि साहब हमारा आप या तो बलूनिंग कर दीजिए या कुछ इंटरेस्ट वेव कर दीजिए, है ना, या आप हमारे जो इंटरेस्ट हैं FITL बोलते हैं उसको, फंडिंग ऑफ इंटरेस्ट एंड टर्म लोन. सो वार्डे से कि साहब ये जो आपने अरेंजमेंट किया है, तो दिस अरेंजमेंट इज बेसिकली इफ इट इज सब्सटेंशियल, दैट मीन्स आपका जो एग्जिस्टिंग लाइबिलिटी है वो लाइबिलिटी आपने खत्म कर दिया और एक नया लाइबिलिटी खड़ा हो गया. तो एग्जिस्टिंग लाइबिलिटी जो आपने खत्म किया है और जो कैरिंग वैल्यू है उसमें जो डिफरेंस है दैट शुड गो टू दी प्रॉफिट एंड लॉस, और फिर आप एक नया लाइबिलिटी खड़ा करिए बेस्ड ऑन दी जो भी ये कैलकुलेशंस करके और प्रेजेंट वैल्यू निकाल करके. तो दैट इज हाउ अकाउंटिंग ट्रीटमेंट इज डन. तो पहले लाइबिलिटी को पूरा डी रिकॉग्नाइज करना है और नई लाइबिलिटी को रिकॉग्नाइज करना है, और अगर नॉट सब्सटेंशियल है तो फिर आपको डिफरेंशियल का एडजस्टमेंट करना है.
So let us see the accounting treatment in case of non-substantial modification. In this case, no derecognition will take place. We will simply adjust the carrying amount to the present value of modified cash flow, and the difference, if any, will be transferred to P&L account. We will use the original EIR to calculate interest expense. So let's have a illustrative example. Original loan of rupees 5 lakh with carrying value rupees 4 lakh 60,000 modified the new terms with present value is rupees 4 lakh 50,400. The difference is only 1%, hence it is a non-substantial. So difference of rupees 4,600 will be transferred to P&L account. Modification of financial assets. Financial assets undergo very different assessment criteria. Unlike financial liability, there is no only 10% rule. We will simply assess the contractual terms in which we compare the original versus modified cash flow, and we will apply substantially different tests in which qualitative and quantitative assessment will be done. And the outcome is substantially different. We will absolutely recognize the old financial asset and we will recognize the new financial asset at fair value, and the difference, if any, will be transferred to P&L account. If the modification is not substantially different, then we will recalculate the gross carrying amount using original EIR. Difference, if any, will be transferred to P&L, and interest income will be computed arising using original EIR. So now question for the offline participants. Company modifies a financial liability with the following details. Carrying amount is rupees 10 lakh. Present value of modified cash flows is rupees 9 lakh 20,000. Difference is 8%. What will be the correct accounting treatment? Options are: option A, we recognize old liability and recognize new liability at fair value. Continue old liability and adjust carrying amount using original EIR. Option C, recognize modification loss in OCIs. Option D, no counting entry required. Yes, correct answer is 3. Since the difference is less than 10%, modification is not substantial and we will simply adjust the carrying amount. So let us see the special case in which modification can happen due to pre-existing relationship. There are some cases where pre-existing relationship arises, like supplier-customer relationship. If there is a supplier-customer relationship, in this 115 will prevail. If there is an employer-employee relationship, we will treat the concession as per Index 19. If there is a shareholder relationship like subsidiary and parent relationship, then Index 102 or Index 32 will prevail. Accounting treatment principle. When modification arises from pre-existing relationship, then fair value of loan is equals to present value of modified cash flows discounted at market rate. And implied concession will be treated as the governing index. Now let's have a practical illustration which substantiates the accounting treatment. Let's say an employer given loan of rupees 10 lakh in which interest rate is 4%, where the market interest rate is 10%. Tenure of the loan is 3 years, and present value of modified cash flows at 10% is rupees 850,000. After 1 year, modification took place, and the rate, which is originally 4%, is reduced to 2% for the remaining tenure. Carrying amount at original EIR is rupees 9 lakh. Present value of modified cash flows at original EIR is rupees 87,000. And the modification loss is rupees 9 lakh minus 8 lakh 70,000, that is 30,000. It will be transferred to employee benefit expense account debit to loan to employer. Key principle is, since modification arises from employer-employee relationship, the difference of 30,000 is treated as an employee benefit expense under Index 19 and not as finance income or loss under Index 109. Now the question for the offline participants: an entity reduces the interest rate on employer loans due to continued employment. The modification results in a loss of rupees 25,000. How should the loss be recognized? Option A, finance cost. Option B, OCI. Option C, employee benefit expense. And option D, capital reserves. Yes, it will be transferred to employee benefit expense since it is a pre-existing relationship arises. Now let's move on to the next very important topic: regular way purchase or sale of financial assets. So let us understand what is regular way transaction. A purchase or sale of financial asset under a contract requiring delivery within time frame established by market conventions. So market conventions are typically T+1 or T+2 settlement for equities listed on recognized stock exchange like NSE or BSE. Trade date is the date when entity commits to purchase or sell the financial asset. Settlement date is the date when the financial asset is actually delivered. And in trade date accounting, we recognize the asset and payable receivable on trade date. Subsequent fair value changes recognized immediately. In settlement date accounting, asset recognized only on settlement date. Fair value changes between the dates will be treated based on classification. So let's have a comparative analysis of trade date accounting versus settlement date accounting. Aspect 1, initial recognition. In trade date accounting, asset in payable receivable recognized on trade date. And in settlement date accounting, asset recognized only on settlement date. Aspect 2, subsequent measurement. Fair value changes recognized immediately in trade date accounting. While on other hand, in settlement date accounting, fair value changes between trade date and settlement date is handled as per the classification. every typical classification. In trade accounting, changes in any value will be transferred to P&L after the trade date. In settlement date accounting, the changes will be transferred to P&L during a time period. FET OCI classification. In trade date accounting, in this classification, changes will be treated in OCI from the trade date. And in settlement date accounting, changes will be transferred to OCI during the time period. Amortized cost in trade date accounting, financial asset is measured at amortized cost from the trade date, and in settlement date accounting, no fair value change during the time period since it is a amortized cost. Let's have a practical illustration in which the scenario is trade date is 1st March, settlement date is 4th March, agreed value is rupees 10 lakh, fair value on 4th March, that is on settlement date is rupees 10 lakh 50,000. Classification is based on FVTPL. So in trade date accounting, what will be the journal entries? On 1st March, since it is a trade date accounting, we will recognize the asset and we will recognize the payable. I investment account debit to payable account is 10 lakh. Between 1st to 4th March, the change of 50,000 rupees will be recognized as investment account debit to P&L account. Why P&L account? Since it is a FVTPL classification. On 4th March, that is on settlement date, we will pay the balance which was agreed on trade date, that is payable account debit rupees 10 lakh to bank account debit rupees 10 lakh. How it will be presented at balance sheet? In balance sheet, we will show the investment at rupees 10 lakh 50,000 and in rupees 50,000 gain will be transferred to P&L account. So let's move to the next impairment under English 09. Let's have a overview of ECL model. The expected credit loss model under English 109 represents a significant departure from the previous loss incurred approach. This is a forward-looking framework requires entity to recognize provision based on lifetime ECL rather than waiting for a credit event to occur. This model introduces three-stage approach to impairment recognition, where the stages depend on whether there is a significant increase in credit risk since the initial recognition of the financial instrument. Let's have a detailed discussion on three-stage ECL approach. The impairment model classifies financial asset into three distinct stages. Let's discuss one by one. Stage 1. Stage 1, where there is no significant increase in credit risk since initial recognition. We will forecast the loss allowance for the upcoming 12 months and interest will be charged on gross carrying amount. In stage 2, there is a significant increase in credit risk since initial recognition and the loss allowance will be lifetime ECL. And interest revenue will be simply charged on gross carrying amount. In stage 3, there is a evidence of impairment, hence credit impaired. Loss allowance will be lifetime ECL and interest revenue will be charged in net carrying amount, not on gross carrying amount after deducting loss allowance. Interest revenue is always calculated using the original EIR adjusted for the stage classification. Now, components of ECL measurement. How ECL is calculated? ECL is equals to PD multiplied by LGD multiplied by EAD. What is PD? Probability of default. Estimates the likelihood that the borrower will default on contractual payments within a given time period. Typically, it is expressed in percentage and can be determined using historical data. What is LGD? Loss given default. Represent the percentage of exposure that will be lost if a default occurs. Factors affecting LGD include collateral quality, recovery rates, and seniority of debt instrument. What is EAD? Exposure at default. The total value at risk at the time of default, including outstanding principal and accrued interest and any other amount to be utilized. So let's understand it a practical illustration. A bank grants a loan of rupees 10 lakh with original EIR of 12%. The 12-month PD is 2% and LGD is 40%. Calculation will be 2% multiplied by 40% multiplied by 10 lakh. That is comes to rupees 8,000. We will recognize that a present value since it is occur after 1 year. Journal entry will be impairment loss account debit to loss allowance. Now, question for the online participants. The loan has been classified in stage 2 under the ECL model. Which statement about impairment recognition is correct? Options are option A, recognize 12-month ECL, option B, recognize lifetime ECL, option C, no impairment is required, and option D, calculate interest on net carrying amount.
Pulkit.
Option B.
Yes. Option B is the correct answer. Stage 2 classification indicates a significant increase in credit risk since initial recognition. So let us see the accounting entries for impairment and presentation of impairment loss. On initial recognition of impairment, we will pass the journal entry by debiting the impairment loss account debit and crediting the loss allowance. If there is any indication arises which indicates the reversal of impairment loss, we will reverse the entry which was passed on initial recognition by debiting the loss allowance and crediting the impairment loss. On write off the receivable, we will debit the loss allowance and credit the financial asset. In balance sheet, the net treatment is followed. That is, we will recognize the financial asset at net carrying amount after allowing the provision for impairment loss. Now let's move on to the next topic, derivatives framework. So what is derivative? Derivative is the underlying variable which require very minimal investment and the settlement for the derivative is to be happened at future date. Underlying variable is the value changes in response to specified variables, including interest rate, foreign exchange rate, commodity price, or equity indices. Minimal investment says that no investment or very minimal investment is required for these type of contracts, and the settlement occur at a future date rather than at present moment. Now let us see the common examples of underlying variables. Interest rate movements, foreign exchange rate fluctuations, commodity price changes, equity price relations. Derivatives is always measured at FVTPL unless it is designated to have accounting under specific criteria. Now let us see the recognition and measurement criteria for derivatives. Initially, we will recognize the derivative at fair value, and many forward contract derivatives have zero fair value at inception, recording in no journal entry. On subsequent measurement, it is always calculated at FVTPL, and since it is FVTPL, the difference will be charged to P&L immediately. In balance sheet, if it is a positive, then we will show it as a derivative side, and if it is negative fair value, then we will show it as derivative liability. Now let's have a practical illustration for a foreign currency forward. See a contract terms where entity entered into a forward contract to buy $1 lakh at rupees 82. Forward rate at inception date is rupees 82. Forward rate at reporting date is rupees 85, and the reporting period is 1 year. Since the entity has already entered into a forward contract, we will recognize the difference, that is fair value gain of 85 minus 82, which results in rupees 3 lakh gain, and we will charge the journal entry. Derivatives and debit to gain on derivative is 3 lakh. Now let's see the embedded derivatives framework. What is embedded derivative? Embedded derivative is a feature embedded within the contract which create additional risk exposure. So what is hybrid instrument? A financial or non-financial contract that combines two elements, post contract and embedded derivative. Now for understanding the embedded derivative, we will understand the common examples of this concept. First is debt instrument linked to commodity price movements. Second is lease agreement with inflation rental adjustment. Third is foreign currency clause in non-financial contract, and the last is equity index payment features. Now let's have a detailed analysis on whether the embedded derivative is closely related or not closely related. Let's see the different scenario. Scenario 1, floating rate linked to the benchmark rate. Are they closely related? Yes, they are closely related, and hence no separation is required. Secondly, debt instrument linked to equity index on or unrelated commodity. No, there is no any relationship. Since there are no relationship, we will separate the derivative. Entities functional currency. Yes, there is a relationship, and hence we will not separate the contract. Foreign currency amount in third currency, neither functional nor presentational. No, there is no relation. Hence, there is no relation. We will separate the currency derivative. And the last is fixed rate aligned with market rate and inception. Yes, they are closely related and no separation will be required. So what is the rationale behind that assessment? The closely related test ensures that only genuinely different risk exposures are separated. Not all the risks are to be separated. For example, if floating rate based on the same benchmark as market rate does not introduce new risk. Since there is no new risk, we will not be separately contract. There is a practical tip that always document the assessment with quantitative analysis and management rationale, especially for the borderline where the judgment is required. Now let's see the practical illustration in case of embedded derivative. entity A purchases machinery from entity B. Entity A is based Indian-based company and entity B is German-based company. Payment is to be happened in 6 months. Spot rate is rupees 80 per USD at contract date and 85 rupees per USD at reporting date. USD is neither presentational nor functional currency for any of the party. Since it is a part of no presentational currency, we will separate the contract and embedded derivative concept will prevail. At initial recognition, we will record the machinery at spot rate, which was prevailing on contract date, by debiting the machinery and creating a payable. Now, since the clause is not related, embedded derivatives must be separated. At reporting date, we will recognize the difference by debiting the P&L and creating the derivative liability. So, if the foreign currency is functional currency of either party, we will not require the separation. But if the foreign currency is separate and nor presentational nor functional, we will separate the contract. Now, question for the online participants: an Indian company purchases goods denominated in USD. The USD is neither the company's functional currency nor commonly used in pricing such goods. What is the accounting treatment? Option A, measure entire contract ECM. Option B, no separation is required. Option C, currency clause is closely related. Option D, separate the embedded derivative FVTPL.
Pramod. Pramod. Aditya Bansal.
Option D, separate embedded derivative at FVTPL.
Answer. So now let's move on to the next topic, financial guarantee. So now let's move on to the next topic, financial guarantee. So what defines a financial guarantee? It is a contractual obligation in which an agreement requiring specified payments to reimburse the holder for losses incurred when a debtor fails to make payment is promised, and it provides credit protection in which transfer credit risk from the holder to the issuer. The guarantee assumes responsibility for potential default losses on underlying debt. So let us see the common examples of financial guarantee. Parent company guarantees for subsidiary loans and bank guarantee issued to support client obligation and surety bonds protecting contractual performance. Now we will see the key clarification in case of financial guarantee. The issuer recognizes the financial guarantee at inception date. Issuer may not account for as insurance unless they choose to index 104. Fair value measurement drives initial recognition and market-based approach determine value when no premium exists. So how financial guarantee will be recognized initially? Financial guarantee are initially recognized at fair value, which typically equals the premium received from the guarantor. However, when guarantees are issued without consideration, such as parent company guarantees for subsidiary, fair value must be estimated using market-based valuation techniques. Let's see your illustration. Parent company guarantees rupees 50 lakh loan of subsidiary. Market analysis determines the fair value of guarantee at rupees 2 lakh. So the guarantee will be recognized at rupees 2 lakh. Investment in subsidiary account debit to financial guarantee liability. What is the rationale behind that record? The capital contribution concept applies here. The parent company guarantee represents a capital contribution into the subsidiary, enhancing its creditworthiness and ability to secure finance. Now, how the financial guarantee will be recognized subsequently? Financial guarantee are higher of two amounts, loss allowance or amortized value. Higher of the ECL or amortized value, ensuring conservative measurement. That is understood by a practical illustration. Initial fair value is rupees 2 lakh. Amortized cost is rupees 1,60,000. ECL estimate is 20,000. So the higher of amortized amount and ECL estimate is rupees 2,20,000. It will be recognized at 2,20,000. Now let's move on to the next topic, hedge accounting. Hedging is a risk management strategy in which management uses financial instrument, typically a derivative instrument, to offset the exposure to changes in fair value or cash flow of another item arising from a particular risk. There are mainly three types of hedging relationships: fair value hedge, cash flow hedge, and net investment hedge. In fair value hedge, in fair value hedge, we will recommend both hedging instrument and hedge item at fair value with changes through P&L. For example, hedging fixed rate debt with interest rates to appreciable. In cash flow hedge, we will account for effective portion to OCI and ineffective portion and hedge item to P&L. For example, forward contract hedging foreign currency forecast purchase. In net investment hedge, we will account similar to the cash flow hedge and with recognition in FCTR, foreign currency transaction reserve. For example, foreign currency derivative hedging, investment in subsidiaries. Now let's have a practical illustration of all three cases. Firstly, with fair value hedge. On 1st April 2021, company has fixed rate loan of rupees 1 crore at 10% interest rate. Market interest rate increases to 12% at the year end. And to hedge interest rate risk, the company enters into an interest rate swap in which they pay floating and receive fixed. So fair value changes determines loss on lend due to increasing market interest rate will be folder and gain on swap will be 390,000. What will be the accounting treatment? We will firstly recognize the derivative asset. Derivative set 390,000 to gain on hedge rupees 390,000. Then we will recognize the loss which was occurred at the loan. Loss on hedge loan account debit folded rupees to loan liability rupees folded. What will be the net impact? Rupees 10,000, which is ineffective portion. Now, question for the offline participant. In a fair value hedge relationship, changes in fair value occur for both the hedge instrument and the hedged item attributed to the hedge rate. Where should these changes be recognized? Option A, both in OCI. Option B, both in P&L. Option C, instrument in OCI and hedged item in P&L. And option D, instrument in P&L, hedged item in OCI. Anyone? Yes, the correct answer is both in P&L. In a fair value hedge, both the changes in fair value of the hedging instrument and the adjustment to the hedged item attributable to the hedge risk are recognized in P&L. So let's see the practical illustration for cash flow hedge. Scenario is company expects to purchase equipment in US dollar for after 3 months. Amount is incepted at US dollar 50,000. Company enters into a forward contract to buy 50,000 US dollar at a fixed rate. Forward contract fair value changes from 0 to asset of rupees 250,000 due to exchange rate movement. What will be the effective portion? Effective portion will be rupees 250,000, and we will pass a journal entry for recognizing it by debiting the derivative asset and crediting the cash flow and reserve OCI. Reclassification is possible when equipment purchase occurs. Amount in OCI are reclassified to P&L, which will achieve the objective of reducing earlier P&L volatility. Now let's see the illustration of net investment hedge. Let's have a scenario where Indian parent company maintains net investment in US subsidiary of US dollar 10 lakh. Beginning rate of USD is 80, year end rate is 85, and transaction gain will be rupees 5 lakh. So the journal entry for translation profit on net investment will be investment in subsidiary account debit to OCI FCTR rupees 50 lakh, and subsequently the exchange loss will be occurred on loan which will taken by parent company for maintaining investment in subsidiary by passing the journal entry OCI account debit to foreign currency loan. Now let's move on to the last topic of this index, disclosure of financial instrument under index 107. What are the objective and categories of the disclosure requirement? Index 107 mandates comprehensive disclosure to enable users of financial statement to assess both the significance of financial instrument for financial position and performance and the nature and extent of associated risk. There are many disclosures related to financial position, firstly categories and classification, detailed categorization of financial asset and financial liability, including reclassification disclosures. Carrying on process fair value will concise presentation showing fair value and its relationship. And the offsetting disclosures will be required to be given by the entity, which will be help for the public to have a clear picture. Disclosure related to financial performance, net gains and losses, interest income and expenses, fee income and expense, impairment losses. These all are related to P&L and will be transferred to profit and loss account. Now let's have a detailed discussion for disclosure of financial position and performance. Categories of financial instruments. Entities must disclose carrying amount for each category. Category 1, financial asset measured at amortized cost. Category 2, financial asset at FVTPL. Category 3, financial asset at FVTOCI. Category 4, financial liabilities at amortized cost. Category 5, financial liabilities at FVTPL. In a statement of loss, the entity required to disclose net gains and losses by category, interest income using EIR, fee income or transaction fees, and impairment losses. Fair value disclosure required to be given by the entity, in which they have to compare the fair value versus carrying amount and valuation techniques applied, classification within the fair value hierarchy, that is level 1, level 2, level 3. Reclassification and collateral. Details of reclassification between categories and reasons for such changes are required to be given by the entity, and information about collateral held or pledged is required to be compulsory given by the entity. So let's move on to the next disclosure. This disclosure qualitative requirements. Index 107 mandates comprehensive qualitative disclosure explaining how entity identify, measure, and manage financial risk. So financial risk can be of different types: credit risk, liquidity risk, and market risk. Credit risk simply states the risk of financial loss from the counterparty failure to meet contractual obligations. Liquidity risk states the risk of difficulty in meeting obligations associated with financial liability. And the market risk states the risk of changes in market prices affecting a sum or instrument value. What are the required qualitative elements? Exposure to each risk type and how they arise. Risk management objective, policy, and processes. Third is methods used to measure and monitor risk. And the last is change in risk management approach from the prior period. Management perspective is required for proper disclosures. Disclosures should reflect the internally policy to ensuring consistency between internal risk and governance and external reporting frameworks. Now, quantitative risk disclosures and sensitivity analysis. Quantitative disclosure requirements are slightly different. Entity must provide summary quantitative data about the risk exposure at the reporting date, in which information is based on internally key management personnel. Concentrations of risk with explanation of common characteristics. Maximum exposures to the credit risk at the time of class of financial instrument. Maturity analysis for financial liabilities showing contractual maturities. And sensitivity analysis demonstrating effects of reasonably possible market changes. For market risk sensitivity analysis, how the profit and loss and equity would have been affected after the risk variables at the reporting date. Entity must cover the 100% risk coverage, in which all financial instruments within the scope must be analyzed. All the three categories, including credit risk, liquidity risk, and market risk, should be analyzed. And all the three levels, level 1, level 2, and level 3, should be addressed. So thank you everyone. This is all from our side.
पे जो डिस्क्लोजर्स देते हैं कुछ आपने निकाल नहीं क्या क्या प्रैक्टिकल डिस्क्लोजर जो कई सारी कंपनीज देती है वो निकाल के बताने के लिए ये इस तरीके के डिस्क्लोजर्स दे रहे हैं समझ ही नहीं आएगा हाँ भाई अंदर डिस्क्लोजर दिए थे तूने इंडेक्स में रिस्क के कैसे डिस्क्लोजर है बता तो बताओ ना
बहुत सारे डिस्क्लोजर्स आते हैं जब अपन इंडेक्स के अकॉर्डिंग फाइनेंशियल्स बनाते हैं तो उसमें क्रेडिट रिस्क वाले डिस्क्लोजर्स आते हैं और जो भी ईसीएल वाला जो अपन इम्पेयरमेंट कैलकुलेट करते हैं फाइनेंशियल्स के अंदर वो सारे जाते हैं। उसके अलावा सेंसिटिविटी एनालिसिस उसके अंदर हमें बनाना होता है। तो ऐसे बहुत सारे डिफरेंट टाइप्स ऑफ डिस्क्लोजर उसके अंदर।
तो देयर आर लॉट ऑफ डिस्क्लोजर्स तो कई बार अपन जब तक उसको प्रैक्टिकल बताएंगे नहीं ना ये सब ये ऐसे डिस्क्लोजर होते हैं ये क्वेरी हो जाएगी। रिस्क है तो जैसे कैसे आप रिस्क को मिटिगेट कर रहे हो आपने डेटर्स अगर मान लीजिए आपके ज्यादा हैं तो आपने उसके लिए कुछ और उसको मिटिगेट मतलब रिकवरी ऑफ डेटर्स को मिटिगेट करने के लिए कोई रिस्क कुछ आपने अरेंजमेंट किए हैं क्या या और क्या कैश बैलेंसेस करते हो क्या है। So lot many things are there which need to be reported here that how do the company what are the risks and how do the company manages those risks वो भी उसमें लिखना पड़ता है। और अगर मान लीजिए कुछ चेंज हो जाता है, सेंसिटिविटी एनालिसिस देना होता है। जैसे मान लीजिए फॉरेन एक्सचेंज के अंदर आपके डेटा हैं, तो सेंसिटिविटी एनालिसिस मीन्स मतलब अगर फॉरेन एक्सचेंज एकदम से सपोज उसका वैल्यू बढ़ गया डॉलर का, तो आपको कितना लॉस हो सकता है। तो these things are required to be reported in these disclosures. So anyway, it was good discussion. I think एक नर्सेल में करीब करीब सारे फाइनेंशियल इंस्ट्रूमेंट्स के टॉपिक्स कवर कर लिए, और आपके जहां जहां पे भी इंडेस है वहां ये सब में काम आता ही है। wherever there index applicability is there for the auditee client as well as wherever we are providing consultancy to them. तो the point is कि इसको आप proper तरीके से you should learn not only for your exams purpose but for your deliberation at the client also. रिकॉर्डिंग बंद कर दी क्या?
हाँ
वो क्या लिस्ट जो लंच कर रहे थे